Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
Well, the Bank of England's chief economist said last month he didn't mind being accused of taking a sledgehammer to crack a nut as long as it was delivered promptly. Today it was, as the governor did all he could to stop Britain slipping into recession. Interest rates are now at a record low and tens of billions of pounds are being pumped into the economy. The moves came as the bank's quarterly inflation report warned that the Brexit vote would slam the brakes on economic growth, triggering rising unemployment and falling house prices. Our business correspondent, Helia Ebrahimi, has this.
The Bank of England reckons taking a sledgehammer to crack a nut is better than relying on a miniature rock hammer to tunnel out of prison. And that's exactly what they've done today. A cut in interest rates to a historic new low, £60 billion of quantitative easing, £10 billion of corporate bonds, and £100 billion of further credit easing for banks. And it was a big day for Mark Carney, a nervous bite of the lip before delivering his £170 billion plan to rescue the economy.
Today's announcement is the latest element of the bank's joined-up policy response to the referendum, a plan that was based on months of extensive analysis of the risks, detailed planning, and appropriate public communications. A plan that delivered a broad range of contingency measures to contain the immediate impact on the financial system of the result of the referendum.
What the Bank of England is saying today is that it is more worried about the impact on jobs, the impact on growth in the economy, than it is on inflation in the future. And it's not hanging about. So it's really hit us with sort of all four barrels, if you like, today. And I think the first rate move since March 2009, it's clearly a massive day in UK economics.
In 2009, the Bank of England was forced to take emergency measures, cutting interest rates to unprecedented levels. As the years went on, everyone expected there to be a rate rise, but the UK economy was slow to recover. For more than 7 years, rates have been kept on hold. But now, the Bank of England, post-Brexit, has been forced to take action. As the bank tries to manoeuvre the economy into a better position, there are obvious losers, most notably savers and pensioners. These bowls players in Oxford say they're fed up.
Well, I think it's unfair because you work all your life to get a pension, then you suddenly find you haven't got one. Or if you have, it's very small.
For me personally, bad news, and for everybody that relies on investment savings to add on to their pension in particularly.
Pensions experts warn this could affect not just the retired, but anyone saving for their future.
I mean, it's an absolute disaster for savers, really. We're talking about a lost decade when you've got next to nothing on your cash, and it's looking like that's going to be the case right up into 2020. So really bad news if you've got any cash in the bank from the Bank of England today.
The bank says the vote to leave the EU could cost the British economy around £45 billion in the next 3 years and around 250,000 jobs. The GDP forecast has been slashed from 2.3% next year to just 0.8%. However, like so many weather forecasts, the winds have also changed for the bank's predictions of a recession. Now it seems, thanks to today's programmes, predictions of negative growth have blown away. Good news too for the young or the indebted. Money just became cheaper and for a lot longer.
Especially as a young person, it's really difficult now. And as I said, I'm just hoping that, things would get better, in the near future.
Rate cut, good news or bad news?
Good news.
Good news for your generation?
Yes, yeah. Old people do owe it to the new generation. I think the rising house prices are an example of intergenerational theft.
Yeah, it's getting quite expensive. And I think I'll advise anyone who can get on the ladder now to get on before it becomes quite ridiculous.
Today's measures offer a sunny outlook for consumers. It lays down a marker for the Chancellor to roll out his stimulus plans and showcases Mr. Carney as the hero of the hour. But the truth is, no one quite knows whether such extreme economic policies will come close to keeping Britain afloat or create more distortions down the line.
And Helia is with me now. Helia, what to make of it all?
Well, look, this is the second biggest action that the Bank of England has ever taken, and it's a really historic day. But the governor was very keen to stress that this should trickle down to everyone in the economy. He really pointed out that banks have no excuse not to pass on these rates to their customers. For those at home, that means availability of credit. It also means cheaper rates through this more difficult economic cycle. And for banks, it means offering those rates without hurting their profits. And I guess for Mr. Carney, it's finally a chance, after 3 years of having his forward guidance policies really criticised, he was able to flex his muscles as the person that comes in and actually rescues the day. I think the question is, what do they do now? And what does the government do now? I asked the governor earlier when I spoke to him, had the bank got it wrong when they predicted a recession? Or was the action they did today actually staving off that eventuality?
There's no question. You've seen the scale of the action that we've taken. This makes a difference. It makes a difference, and it
makes the difference between recession and not recession?
Look, you can draw your own conclusions. We have growth, very modest growth in the second half of this year. And monetary policy does take time to work through.
Even you know there's limits to what monetary policy can achieve,
well,
and you've outlined that today. Do you think, you said the challenge needs to be dealt through structural measures? Does that mean today you're saying the bank's done its bit? Over to you, Chancellor.
Well, the biggest issues are structural. New relationship with Europe, new relationship with the rest of the world, the government's productivity plan that it's developing. Those will make the biggest difference to the long-term prosperity of this country. Monetary policy just helps with the ups and downs and smoothing things out. It's foundational, but it doesn't determine prosperity. But monetary policy can act quickly. It can act comprehensively. It can act in a way that helps with that adjustment to those new levels. Decisions on fiscal policy and decisions on structural policy take longer.
Is that the big job, though? This is a huge stimulus package today, but is the big job really for the Chancellor to do?
Well, the big jobs, the big determinants of our prosperity, of wages, of ultimately house prices, of activity in this economy, our export competitiveness, absolutely will be determined by government policy. It does not follow, though, that monetary policy shouldn't act when it can act. Look, the Chancellor and I have been in close contact, met numerous times since his appointment. He made clear in his letter today that he and the government would take all necessary steps to support economic activity and confidence. Again, but government operates on a different time frame.
The bank is just better placed to act quickly.
We have instruments that can act more rapidly, and the people rightly expect us to use them.
What about for savers? This is the big topic. After 7 years of emergency level interest rates, and we've experienced growth in those years, are you saying to savers, you might as well give up? You don't need to save anymore. You're never going to earn a return on any of this money. Well, you're going to have low interest rates for ages now.
The judgment we have to make for the economy as a whole is what's the right stance of policy to support overall growth, to minimize unemployment in the context of keeping inflation.
Even if it punishes savers?
We work for the economy as a whole. The economy as a whole. Look, I have tremendous sympathy for the situation of savers. They've done the right thing. They've set money aside. They're not earning the returns they would have seen in the past.
And what's your message to them? Be patient. Think of the wider economy.
Well, I think we do have to think of the wider economy. You think of as savers, your children, your grandchildren. Are they going to be employed? What type of job are they going to have? What are their prospects? Would we be in a better position if we had higher interest rates and we had a deep recession? No. Clearly, as a whole, we would not.
But if you're talking about the wider economy as a whole, you've launched a very big stimulus package with a lot of QE, but there's a lot of debate about what QE actually achieves. It inflates asset prices, makes house prices bigger, it makes shares worth more. It's not clear that that trickles down to the rest of the economy, given the Brexit vote has uncovered how many people in Britain feel like they've been left behind. Isn't there a risk that more QE is just going to exacerbate that feeling of wealth disparity?
We've thought long and hard about how to make sure this stimulus reaches through the financial system to the real economy. So if you're a business person and you have a viable business idea, you can get credit. If you're a young family and you would have qualified for a mortgage 2 months ago, that you can still qualify and get that mortgage, and you can get that mortgage at a more competitive price today in order to buy that first flat or that first home. That's what we're doing. We're making sure that the system continues to work on the high street. This is not about the city. This is about reaching through the financial system to the real economy. That's why we acted on multiple fronts. That's why we're buying corporate bonds in a way that reaches through to the businesses that have, not any business, sorry, Helia, not any business, but businesses that have material activity in the UK, businesses that invest in this country, businesses that hire our fellow citizens. So that is what we're doing to make a difference, to have stimulus that hits not just the high street, but across the entire economy.
Okay, thank you.
Thank you.
Helia Ebrahimi talking to the Bank of England governor. Well, with me now is Gerard Lyons, who's co-founder of Economists for Brexit and chief economic advisor to Boris Johnson during his time as Mayor of London, and Ray Newton-Smith, the CBI's Director of Economics. Gerard Lyons first. The fact that the Bank of England did more than expected just shows how bleak the economic outlook is for Britain, doesn't it?
No, it shows that there's near-term challenges. Basically, if one looks at the outlook for the UK, it depends on the interaction between the economic fundamentals, policy and confidence. There's no doubt that confidence has taken a big knock in the last 6 weeks, and therefore how the economy performs in the very near term is really going to be heavily influenced not only by confidence but also by the policy measures.
When you talk about near-term challenges, I mean, let's be clear what that means. That means the biggest cut to growth forecasts since the Bank of England started forecasts.
While I agree with most of what the Bank of England did today, I do think their growth forecast over the next year and a half is probably too weak. Before the referendum, I did say that Brexit would be positive for the economy. I still think it will be. But at the same time, I did say that Brexit, or voting for no, would lead to an economic shock, and the Treasury Select Committee quoted me in their report earlier this year. So
let me put that to Ray Newton-Smith. Are you as gloomy as the bank?
I think what we've seen today is the bank has taken some welcome measures to shore up business and consumer confidence, and that's what we need to see now. But I think, and so businesses will welcome this, but for the majority of businesses, the most important priority at the moment is for us to have clarity about what will be our trading relationship with Europe, how we will have access to talent and skills from Europe and from the rest of the world.
So the government's got to get a move on.
Yeah, we need to see a clear timetable from government. But importantly, if I'm a producer, a car producer in the northeast of England, I want to know what sort of tariffs I'm going to face if I'm moving goods and services across borders in 5 to 10 years' time, if I'm going to be investing now. So we need clarity on where we're going forward.
And that's the point, isn't it? That clarity is going to be a very long time coming. And so those near-term challenges, as you put it, are going to be, well, perhaps medium-term.
No, well, I don't think so. It's true that today's actions, while they're very positive, I think will be good for the economy in the near term, they should be seen in the context of a number of things. First, in the last 6 weeks, we've seen the pound fall, which is good. Also, we've seen financial markets...
Depends which side, where you're sitting.
Well, it is good for the economy because inflation is not a near-term problem. And what we've also seen in the last 6 weeks is clarity about the fact that this is not like 07 and 08, when we had a financial crisis. But also today we've had the Bank of England. The next stage is the government with the autumn statement. We need to see measures aimed at the middle income, people who've been squeezed. We need to see measures aimed at boosting infrastructure. And basically, I think we need to see an end to austerity. So in the autumn statement, that will be the next stage of a process. And when you add it all together, today's monetary policy, the fiscal policy, and also the last 6 weeks, I think people should then start to be reassured. The worst thing is if we talk to ourselves into a self-feeding downturn.
OK, let me put that end to austerity. So it's over to the government now, is it, Rain?
Well, I think it's right that a lot of the tools that are at the government's disposal do rest in the autumn statement, and that we need to see a focus there on research and development, on encouraging investment, and all these
But an end to austerity, would you agree with that?
Well, I think it's really about getting a focus on the long-term productivity in our economy, because we're facing a long-term challenge to our whole relationship with Europe, our relationship to all the countries through which we have trading agreements through being a member of the European Union. That has an impact on our long-term growth prospects, which is what the governor was talking about in the press conference today. And that's why we need to see government policy doing what it can to support, and businesses as well need that clarity so they can invest for the future.
What do you mean by an end to austerity? I mean, be specific now. Three measures that you want the Chancellor to introduce.
Right, one size doesn't fit all. So we need to have a global policy for the UK economy about positioning ourselves in the changing, growing global economy. In terms of specific measures, earlier cuts in corporation tax, a commitment to cut income tax or raise allowances sooner, and more importantly, borrowing for infrastructure.
So investing in housing,
housing, the whole supply side of the economy. Really, when one looks at it, the economy needs more innovation, which is longer term, more investment by the private sector, which today's measures from the Bank of England are half aimed at encouraging, and more infrastructure spending. We have all that, and it will be good.
Put that to, do you agree with those three measures?
So I think one of the things we absolutely do need to see is investment in our infrastructure and some of the critical decisions made by government. They need to show that the UK is open for business. And what would help with that is having a decision on aviation capacity in the southeast. How are we going to move our goods and services from the UK to the rest of the world? We really need to get on and make a decision on some of these important measures.
Rain Newton-Smith, Gerard Lyons, thank you very much for joining me.